We've all been told a convenient lie about how our economy really works. We're supposed to believe there's a clear wall separating the government that creates money from the businesses that compete for it. But something happened on March 23, 2020 that shattered this illusion completely. As the entire world went into lockdown and stocks were crashing hard, the Federal Reserve quietly handed over its most important emergency powers to a private company. This wasn't just bringing in some outside help. They gave complete control of the money-printing machine to the world's biggest investment firm, BlackRock. To really grasp why this single moment killed true free market capitalism and replaced it with government-controlled monopoly capitalism, we need to look at exactly how this bailout actually worked. Back in 2008, the government rescued the failing banks. Everyone knew about it, it was controversial, debated in public, and all over the news. But in 2020, the Federal Reserve wanted to save the entire corporate bond market, and they faced a serious legal roadblock. The law that created the Federal Reserve back in 1913 is extremely clear about what they can and cannot do. The Fed is allowed to purchase government bonds, treasury securities, and mortgage-backed securities from government agencies, but they are absolutely prohibited from buying bonds issued by private corporations. They cannot buy debt from companies like Apple, Ford, or Exxon. If they crossed that line, it would mean the government was choosing which companies survive and which fail, essentially taking over private businesses. They set up what's called a special purpose vehicle, or SPV. This is basically a shell corporation, typically registered in Delaware to take advantage of certain laws. The Treasury Department injected $75 billion of taxpayer money from the CARES Act into this shell company as starting capital, multiplying it 10 times over through leverage. On paper, the Fed wasn't purchasing corporate bonds directly. The SPV was doing it. It had no trading team, no office, no infrastructure. It was nothing more than a bank account and some legal paperwork. So who was actually going to spend all that money? Who would decide which corporate bonds get purchased and which companies get left behind to sink? The Fed didn't have the technology or the know-how to trade billions in corporate debt in real-time markets. That's when they brought in BlackRock. More specifically, they contracted BlackRock's Financial Markets Advisory Division, their FM unit, to run the entire SPV operation. This created what might be the most outrageous conflict of interest in financial history. Larry Fink, who runs BlackRock, was now playing both sides of the game at once. On one hand, he was responsible for protecting his private clients' pension funds, international wealth funds, and ETF investors who collectively own trillions in corporate bonds. On the other hand, he was now working for the Federal Reserve, choosing which corporate bonds the government should purchase to prop up the markets. This was like putting the fox in charge of protecting the chickens. Except you also gave him the keys to the co-op and paid him with government money to do it. And what exactly did BlackRock purchase using the Fed's unlimited funds? In those first critical weeks of the program, they didn't just buy individual corporate bonds. They bought exchange-traded funds ETF. And which companies' ETFs did they choose? Their own? Looking at the Fed's official transaction records, almost half of the initial buying spree went toward shares of BlackRock's own iShares ETFs, specifically funds like LQD and HYG, so the Federal Reserve was literally creating money out of thin air to buy BlackRock's own financial products, which pushed up the value of assets that BlackRock controls, which meant more fees flowing to BlackRock. And on top of all that, BlackRock was collecting a separate management fee just for running the buying program. It created a perfect circle where money just kept flowing to the same place. The line between government and corporation had completely disappeared. They'd become one unified power structure. But this backdoor connection runs even deeper than just what happened during the 2020 crisis. The 2020 bailout was actually just putting into action a strategy that BlackRock had already written up months before any pandemic. In August 2019, at an elite economic gathering called the G7 Summit in Jackson Hole, Wyoming, BlackRock released a detailed report called Dealing with the Next Downturn. In this document, BlackRock's analysts made the case that when the next economic crisis arrived, the standard approach of cutting interest rates wouldn't save us because rates were already sitting near zero. They proposed something radical that they called going direct. Their argument was that the central bank needed to find a method to inject money straight into the hands of both public and private spenders, completely skipping over the traditional banking system. The pandemic hit, and the Federal Reserve executed exactly what BlackRock had outlined. They went direct into the corporate credit markets using BlackRock as their middleman. Many experts argue that BlackRock didn't just forecast what the response would be, they actually designed it. They created the instruction manual that the government followed, making sure they'd be the ones chosen to carry it out. This kind of power comes from BlackRock's secret advantage, a system called Aladdin. Aladdin stands for Asset, Liability, Debt, and Derivative Investment Network. And it's way more than just some software. It's basically the brain controlling the entire global financial system. It's a massive risk analysis platform that keeps track of more than $21 trillion worth of assets. BlackRock isn't the only one using it. Vanguard uses it, State Street uses it, Microsoft and Apple use it, and most importantly, the Federal Reserve itself relies on it. Ever since the 2008 financial crisis, the Fed has depended on Aladdin to evaluate the dangers lurking in our financial system. When government officials need to understand what's happening in the markets, they don't check their own data, they're looking at BlackRock's screens. This gives BlackRock a complete information advantage. They can see the trades, the risk positions, and the money movements of both their competitors and the government at the exact same time. Back in 2008, when the government was trying to figure out which banks to rescue, deciding between Bear Stearns and Lehman Brothers, they hired BlackRock to examine the toxic assets those banks were holding. Larry Fink knew which banks were broke before even the Treasury Secretary figured it out. Then in 2020, they made this power official and permanent. By managing these SPVs, BlackRock essentially became a secret fourth branch of our government. Nobody elected them. They operate without normal regulations in this role, and they don't answer to voters. Yet they're controlling the flow of American currency. The consequences of this hidden backdoor are absolutely frightening for anyone who believes in free markets. In a genuine free market, prices get determined by real buyers and sellers making independent decisions. In the BlackRock Fed system, prices are artificially managed and controlled. When corporate bond prices drop too far, the BlackRock-run SPV jumps in and starts buying, creating a safety net underneath the market. This eliminates the possibility of failure for the biggest corporations. This explains the bizarre disconnect we saw in 2020 between the stock market and reality. Small businesses across America were getting destroyed by lockdown policies, but the S&P 500, which is dominated by the massive corporations whose bonds the Fed was propping up, kept hitting record highs. The backdoor system guaranteed that money kept flowing upward to the top of the economic pyramid, to the giant companies that fit perfectly into the BlackRock Fed ecosystem, while everyone else struggled to survive. This wasn't capitalism operating as it should. This was a technocratic command economy being run by computer algorithms sitting on BlackRock servers. And as you're about to see, this concentration of power has enabled BlackRock to force social and political agendas like ESG onto companies, not by convincing them it's a good idea, but by using raw financial power to make them comply or get cut off from the Fed's endless money supply. If the Federal Reserve bailout gave them the ammunition, the actual weaponization of that financial power happened through a tool that most Americans don't even realize exists, something called proxy voting. This is the dry, administrative mechanism that lets BlackRock control how corporate America behaves without needing to own the majority of any company's stock. We're watching the biggest distortion of property rights since the Soviet Union collapsed. In real capitalism, whoever owns the capital makes the decisions. But in our current era, dominated by the big three asset managers, BlackRock, Vanguard, and State Street, there's been a total separation between who owns something and who controls it. Maybe you're a teacher in Ohio with a 401k retirement account, you're the actual owner. You invested your money into an S&P 500 index fund. You're taking all the financial risk. When that stock price falls, your savings shrink. But Larry Fink, the guy running BlackRock, is the one in control. He holds the voting power that comes with your shares. When major companies like Apple, Exxon, or Microsoft need to elect their board members or make decisions on controversial policies, you don't receive a voting ballot. BlackRock receives that ballot, and since BlackRock controls $10 trillion in assets, they consistently hold the decisive voting bloc, typically somewhere between 5% and 8% of every major American corporation. In a landscape where shareholder votes often get decided by tiny margins of just 1% or 2%, BlackRock isn't simply one voice among many. They're the ones who decide the outcome. They have the power to remove a CEO from their job, shut down a corporate merger, or force companies to implement policies that have absolutely nothing to do with making profits and everything to do with advancing political beliefs. This power got turned into a weapon in Larry Fink's infamous 2020 letter to corporate CEOs. In earlier years, Fink's yearly letters were typical corporate cheerleading and encouragement. But in 2020, he dropped a threat. He wrote that climate risk is investment risk. He announced that BlackRock would be increasingly willing to vote against company management and board members when companies were making enough progress on sustainability-related reporting and disclosures. What's that actually mean? Follow our climate and diversity rules, or we'll remove your board of directors. This was the moment ESG, environmental, social, and governance transformed from a nice idea into a forced compliance system. Before this letter, ESG was just an alternative investment approach for people who cared about those issues. After this letter came out, it became a mandatory survival metric that every Fortune 500 CEO had to worry about. Corporate leaders quickly understood that if their ESG rating fell, BlackRock might vote to fire them at the next shareholder meeting. So they rushed to hire chief diversity officers and sustainability executives, not because these roles helped their actual business performance, but to keep their biggest shareholder happy. The most dramatic example of this power play happened on May 26, 2021. This was the day BlackRock staged what amounted to a corporate coup against ExxonMobil's board of directors. For years, Exxon had been fighting back against pressure to abandon oil and gas production. They argued, and they were right, that the world still desperately needs fossil fuels and that their legal obligation was to make money for shareholders, not to save the environment. Then a tiny activist hedge fund called Engine No. One showed up seemingly out of nowhere. They controlled barely 0.02% of Exxon's total stock. In any normal situation, nobody would have taken them seriously. But Engine No. One put forward 4 new candidates for Exxon's board, people who were clearly committed to pushing the company away from oil and gas. Exxon's leadership fought hard against this. They expected their large institutional investors to back them up and support management. They were completely wrong. BlackRock, Vanguard, and State Street threw their enormous voting power behind the tiny activist fund. 3 of those activist board members got elected. Exxon's CEO was publicly humiliated. The message sent to every other energy company was crystal clear. If we can overthrow Exxon's board, we can do it to absolutely anyone. Almost immediately, the entire American energy industry stopped putting money into new production. Why spend billions building a new refinery or drilling new wells if your biggest shareholder is going to remove you from your position for doing it? This investment freeze, enforced through BlackRock's voting power, directly caused the massive underinvestment in energy production that helped trigger the inflation crisis we saw in 2022. The green energy transition wasn't happening because consumers demanded it or because the technology was ready. It was forced through a manipulation of the shareholder voting system. This entire structure creates what's essentially a cartel controlling all capital. In the old days, companies actually competed against each other. Ford wanted to destroy GM's market share. Coca-Cola wanted to crush Pepsi. But now, BlackRock is the biggest shareholder in both Ford and GM simultaneously. They're the largest shareholder in both Coke and Pepsi at the same time. Why would BlackRock want Coca-Cola to cut prices and aggressively compete with Pepsi? That would just reduce the overall profitability of both companies they own. It's actually in BlackRock's best interest for entire industries to function like coordinated oligopolies, raising prices together, reducing service quality, and adopting identical social policies all at once. This explains why you see every major corporation suddenly using the exact same day language: diversity, equity, and inclusion at the exact same moment. This isn't happening by accident or coincidence. It's a top-down instruction from the capital controllers. BlackRock pushes these specific policies through scoring systems like the Corporate Equality Index and similar tools managed by organizations they partner with. If a company refuses to add pronouns to email signatures or refuses to fund certain political movements, their score gets downgraded. When their score drops, BlackRock's algorithms running inside Aladdin automatically flag them as higher-risk investments. Once they're labeled high-risk, their cost to borrow money increases and their stock price falls. This is what stakeholder capitalism looks like in actual practice. Larry Fink claims he's representing stakeholders, the community, the environment, the workers, instead of just focusing on shareholders and profits. But here's the key question. Who actually elected Larry Fink to speak for the community? When you purchase a stock, you're buying a property right. You're buying a legal claim to the future profits that business generates. If Congress wanted to pass a law banning gas stoves or forcing racial hiring quotas, they'd have to hold a vote. They'd have to face angry constituents in the next election. It just gets imposed. It's a method for bypassing our entire democratic system. For about 10 years, BlackRock's total dominance seemed unstoppable and permanent. And they had complete moral authority from friendly media coverage. But in 2022 and 2023, the machine crashed into a serious obstacle. The shadow government made a fatal mistake. They forgot they were managing money that actually belonged to other people. The rebellion didn't start in Washington, D.C. among federal politicians. It started in state capitals across the American South and Midwest. State treasurers in Florida, Texas, West Virginia, and Louisiana had a realization. Their state pension funds, the retirement savings for police officers, teachers, and firefighters were being used to vote against the very industries that provided jobs in their states. Why was West Virginia's pension fund supporting net zero carbon proposals that would completely destroy West Virginia's coal mining industry? Why was Texas's permanent school fund backing policies designed to strangle the Texas oil and gas sector? This was a clear violation of their responsibility to protect retirees' money. In 2024, the Texas State Board of Education delivered the most powerful blow. They announced they were withdrawing $8.5 billion in assets from BlackRock's management. This was the financial world's equivalent of the Bud Light boycott moment. Even though $8.5 billion is a relatively small amount for a firm managing $10 trillion total, the damage to BlackRock's reputation was devastating. They were now seen as a political activist organization. And in the finance industry, once you're viewed as taking political sides, you instantly lose half of your potential client base. This uprising forced Larry Fink into an embarrassing public backtrack. Throughout mid-2023 and into 2024, Fink publicly declared that he was embarrassed by the term ESG and would stop using it going forward. He finally understood the brand had become toxic and was costing them business. But don't be fooled, the actual agenda didn't change one bit, only the marketing language shifted. BlackRock simply renamed ESG investing as transition investing or conscientious capitalism. They stopped talking explicitly about diversity quotas and started using phrases like human capital management. They stopped saying decarbonization and started talking about energy pragmatism. It's a classic corporate magic trick. The algorithm inside Aladdin is still optimizing for exactly the same outcomes and pushing the same policies. But now the marketing materials use different vocabulary to avoid triggering backlash from red state pension fund managers. One that creates a massive opportunity for individual investors to take back control of their own money. It's called voting choice. For many years, BlackRock insisted it was technologically impossible to let millions of individual ETF shareholders vote their own shares directly. They claimed they had no choice but to vote on our behalf for our own good. But when they started facing serious threats of antitrust investigations and potential regulation, they miraculously discovered a technological solution. During 2024 and into 2025, both BlackRock and Vanguard rolled out expanded programs allowing investors in their largest ETFs, You can now select to have your shares voted according to BlackRock's board recommendations, which is the automatic default. Or you can choose from alternatives like a Catholic values voting policy, a climate-focused policy, or a wealth-focused policy that votes purely for maximum profits and votes against all ESG-related proposals. This represents the crack in their armor. It's essentially an admission that separating ownership from control was never legitimate in the first place. We're moving toward a future with pass-through voting systems. If you own shares of Apple indirectly through a BlackRock iShares ETF, the technology now exists for you to directly cast your vote on Apple's board elections yourself, completely cutting Larry Fink out of the process. They'd go back to being just a service provider that processes financial transactions, instead of functioning as a shadow government dictating corporate policy across America. So how can you personally opt out of the BlackRock control system? The strategy breaks down into 3 clear steps. First, activate your voting rights. If you're holding ETFs managed by BlackRock or Vanguard, log into your investment brokerage account and search for the voting choice settings or proxy voting options. Don't just leave it on the automatic default setting. Choose a voting policy that actually reflects your personal values and beliefs. If you don't take action to vote, you're silently giving permission for their agenda to continue. Second, stop funding the system. A whole new ecosystem of anti-ESG or post-ESG investment companies has emerged in recent years. Companies like Strive Asset Management were created specifically to challenge the Big Three by making a promise to vote shares solely based on profit maximization rather than political goals. By transferring your 401k or IRA retirement savings to these politically neutral competitors, you're starving the BlackRock machine of the management fees they use to lobby against your interests. Third, the ultimate escape route. As I've covered in previous videos, the only way to become truly free from this financialized control system is to own assets that can be voted on because they do and have boards of directors or corporate management. Gold doesn't have a CEO who can be fired. Bitcoin doesn't get assigned an ESG score. A rental property you own doesn't need Larry Fink's approval to exist and generate income. The secret backdoor was constructed on the assumption that we'd all remain passive, lazy investors. It depends on us dumping our money into the default fund option and never thinking about it again. The instant we become active participants. The moment the real owner walks back into the castle and takes charge, the manager loses his throne and his power. The era of BlackRock's total dominance is coming to an end, not because the government stepped in to stop them, but because the market finally woke up and realized that allowing a monopoly to control all capital is actually a direct threat to capitalism itself.